Top of the morning. Today's video is on taxation of rental property. So if you are a buy-to-let investor and you're buying a property to rent out, you get hit with tax three main ways. So the first is stamp duty when you buy a property. So around here in Teesside, a lot of the property investors will buy relatively cheap houses. So for instance, £75,000. That you will pay stamp duty on at 3%. So there's £2,250 that you need to find to pay the government just to buy the house. Then you'll pay income tax on the rental income. So a typical rent on that might be, say, £500 a month. You'll get £6,000 rental income a year. If you deduct off your mortgage interest, your repairs, your insurance, and your say gas safety certificate, if you're a basic rate taxpayer, then you'll pay on £2,000 profit, you'll pay £400 tax. But when you are a higher rate taxpayer and you've got rental property, then you can end up paying significantly more. So what happens is HMRC restrict the amount of mortgage interest you can reclaim, and effectively you get a tax credit for 20% of the mortgage interest. You can't deduct it before your profits are calculated. So you can end up paying 40% tax on your profit, but only get to deduct 20% of the mortgage interest. So you can end up in the same scenario where you're making £2,000 profit, you can pay £1,400 out in tax. So you're left with £600 after tax, which is, I think, really unfair. The third way you get caught with tax is capital gains tax when you sell the property. So the difference between what you bought it for, what you sold it for, lesser number of deductions. So your estate agent's fees, solicitor's fees. If you've lived in the property for a period of time, you can also have a deduction for that. But basically, if you sell the property, you will pay either 18% or 28% tax, capital gains tax, on the gain that you make. And there is a very small capital gains tax-free allowance, £6,000 this year, £3,000 next year. So the first amounts are tax-free, but other than that, there's another tax charge to hit you with. So that's three pretty big tax charges for buying a rental property. So it's not a particularly tax efficient investment. If you compare that for a higher rate taxpayer to putting pension contributions away, where you get tax relief on the way in, that, in my opinion, is a much more tax efficient investment. So there you go. Hope you enjoyed it. If you have any questions, drop me a message.